Profit is often perceived as a dirty word in business. The connotations of the term profit are often of selfishness, capitalism, finite thinking. Simply put, profit gets a bad rap. The most successful entrepreneurs preach that businesses should be driven by purpose, not profit, to make the world a better place, to improve the lives of others. Humans need a narrative to tell themselves, a story, to leap out of bed every morning. A company should thus be mission-led, driven by purpose and aspiration, not by profit. Our mission is to be the world's most profitable company. Not exactly inspiring, would you agree? Whilst I agree with this rhetoric, following this advice literally can be dire. The reality is that without profit, your business is a charity. If you're to build a company, an enterprise that outlives its founders, you need capital. Relying on VCs and bank financing is not a long-term business strategy. The only way to be self-sufficient is to generate your own capital in the form of profit. The next type of profit that all business owners should be measuring is known as net profit. Now, I'm sure you're very familiar with net profit. It's simply your sales less your total expenses. Now, there's actually a variation of net profit that I also want you to pay attention to. It's known as EBIT, or earnings before interest and tax. EBIT is the same as net profit, except it doesn't include your interest expenses or your tax expenses. So why? When you want to understand the underlying financial performance of a business, you actually want to look at what we call operating profit. That is the performance of the underlying operations of your business. The problem with net profit is that it doesn't actually give you a true reflection of the performance of your business because it's skewed by interest and tax expenses. Let's compare these two companies as an example. Whilst the two companies have exactly the same operating profit, their net profit is different. Why? Because Company A has interest expenses, has taken on debt from a bank. Company B, on the other hand, has taken funding from a VC, where there is no interest expenses. Now, if you look solely at net profit, you would say that Company B is a better performing company than Company A. That is wrong. Fundamentally, these two companies have the same financial performance. What differs is how their company is funded. Investors like Warren Buffett therefore look at EBIT when trying to understand businesses because he's more interested in the underlying financial performance of the business, not how it was funded. So, next time you refer to profit, just be clear about what profit you're referring to. Is it net profit or is it EBIT?